Graham and Karen join us. We've now got an opportunity for some questions. There should be a couple of microphones running around. Anyone wants to fire up? We've got one, Dave Robinson at the front there. Have we got Kylie just here?
Thanks. Question for David Sackett. David, I agreed with some of what you said and disagreed with quite a bit of it. The one thing I'd like to take you on though is this idea of buying well. I mean, I think a business plan that's based on buying premium properties at 20% below market is just not a plan. You'll just sit around your whole life and never buy anything. I think in the history that we've been buying, we sort of stolen the property from a big corporate. But the rest of them, I think the only realistic thing is to actually pay the market price. And maybe if you're buying 20% below market, you're not actually getting premium properties.
Yeah, well, is that word? Yeah,
Yes.
That's fair. Like, it's a really important issue, and I think in our experience, it's easy to do that when you're relatively small and can be nimble. I think it becomes a bigger and bigger challenge the more capital you've got to deploy, and that's a real issue for the corporates deploying large amounts of money. I think it's a very good objective to have. I get nervous. I mean, I have no problem with buying quality properties and paying what might be above district price, but it's still good value. So it's about value, not about price so much. So yeah, look, I think that is an issue of how do you deploy reasonably large amounts of capital and continue to buy well. Maybe you can't do it long term on large scale. What else did you disagree with that? Don't get them started.
Any other questions? There's one, two. If you want to ask the next question, I might get you to put your hand up a bit early, that way we can get the microphone to you a little bit more quickly.
Frank Delaney, two questions, one to David. All those figures, which I'm not going to dispute, was any MIS in those 1 to 9 figures?
No.
That's all right. To Karen, the productivity report was only up to 2007. That brains chart you put up, small, medium and large.
Yes.
Why haven't we got more up-to-date information in 2007?
Who's Peter Martin?
Yeah, exactly.
It's a good conversation, I think, when Dad said it's something about working.
We might get a microphone to Peter because I think it'd be interesting.
Yeah, look, it's just a computational thing. Data said there's a certain number of years you have to calculate these productivity numbers, and you just haven't got the most up-to-date ones in there yet. It is something we're working on. It's a
6 years old,
it's an extremely time-consuming and expensive process updating those individual farm-level productivity numbers, so we don't do it terribly often. But yeah, you're right, we will do so.
Okay, now I think there's some questions over, unfortunately, Kylie, diagonally the opposite side of the room.
Liam Lanigan, Go Farm Australia. Question back to David again. On the matter of land price, I'm going to pick up on the same point, needing to buy at 10 to 20% below market, coupled with long-term EBIT of 4 to 6%, coupled with the comment that you can't pay market leases and expect to remain viable, is the conclusion rural land prices are too high and we should see a marked correction downwards?
No.
Justify you.
Look, on the issue of leases, I think if you're an existing farm operator and you can take on a lease, then the marginal return on capital is actually quite high. Might be 8 to 10%, something like that. So you can afford to pay 4 or 5. As a standalone operation, I reckon it's a serious challenge because you just can't pay 4 or 5% lease rate on a 4 to 6% EBIT. So I think the lease rate has to come down rather than the land value coming down. I think it's a more likely scenario. buying 10 to 20% under the market. Look, I mean, I don't want everyone to get stuck on that. I think that's an ideal thing to do, and you do it, you get pin your ears back when you can. But it's just about getting in at below market price. Sorry, Liam, I can't remember the third comment you made.
You said justified, I think.
Justified. Oh, I still haven't done that.
Okay, Jay.
Sorry, yeah, I guess the point being that there seems to be a notion that land prices go up in value. We can all bank the capital gain of 6 or 7% year on year, and we'll just suck up the earnings on the way through. I guess my argument would be if you can invest, buy well, manage well, and generate earnings, well then capital appreciation will take care of itself. But to go the other way around,
Well,
it's
that's actually
foolhardy.
Yeah, that's actually what happens though, because if you look at the productivity and the profitability of the top group of farmers, who are the ones who are buying land, it's only the top group that buy. The average performers don't because they don't have the cash to do it. The productivity gains and the profitability improvements on those farms is really impressive, and they're the ones that drive the market. And so we are seeing increased profitability. We just don't see it in when we average over the whole sector. If you pull bits of it out, it's really impressive productivity and profitability gains in those top farms. And so I don't think land is undervalued. I think it's much more likely that the productivity gains we continue to get will continue to drive up.
While we're getting to the next question, an interesting question perhaps Karen or Graham. The notion of the separation of the ownership of capital from the operation of the farm has certainly been discussed a lot. Yet on the figures, David, and that some of you put up, you would find it difficult to justify in terms of the operator and the sort of risks the operator might have. We don't seem to see much evidence of that model really growing to the extent, for example, I think the US has got about 40% of farmland not owner-operated, whereas we don't seem to. Do you see that in any of your figures, Graham or Karen? Are you aware of those figures at all?
Well, I think our figures will show that they're about 5% of, we would define corporate farms in a similar way to David, and something like 5% of farm businesses fall into that category. That's all. Doesn't mean to say that the other owner-operated farms or family farms are not operating on corporate models, but that seems to be roughly the proportion in Australia, which, as you say, is far lower than it is in other countries.
Yeah, probably adding to that, I think there's a really good case for those guys, particularly in that top 25% group where they're getting their 7 or better percent return on capitals. If you can match up that skill with the capital that's coming in by the terms that David's talking about, I think it's a really good match there. We're looking at that happening.
But you're not seeing it to this stage, or?
Only on small scale. So we're dealing with, there's a couple of corporates that where they actually apply that model, but on a smaller scale it's really matched up with very good producers. And that's what we can do.
Question.
Jay Horton, Strategic Partners. My question is to Graham. And I guess the general question is, to what extent is the relatively poorer performance of the medium and small farms a function of a financial or capital constraint? And you gave the example where in the good years they do much worse than the larger farms. Is that because they're clearing a backlog of improvements on the farm that should have been done earlier in years if they had the financing in place?
Part of it, I think a lot of it's just actually recognising a good year when it comes and actually being able to extract the best out of it, or also having a property that's well enough prepared to take advantage of those good seasons when they come. They're not necessarily the smaller farms. In our analysis of those groups, and I guess probably bearing in mind that we don't have the range of small, to the extreme small farms that Karen was talking about, I guess they're a fairly almost homogenous type group. But if we take any data set, the top 25 will seem to start at roughly the same size to maybe some of the top 25 that are a little bit bigger, but certainly by the end of that period they're a lot larger, and that seems to be something that's consistent as we're rolling out those longer-term data sets. So yeah, I think a lot of it's just management. That's just the preparation and the ability to capitalise on seasons when they come. And some of that can be financial constraints, but I think a lot of it's it comes back to management machinery and other constraints.
Andrew Rice from the Graham's Research and Development Corporation. For Graham and David, a lot of focus on the buying well and the understanding of what quality land is. How sophisticated do you think our knowledge is of what quality is in terms of the productive potential, so whether it be the nutrient, the weed profile, or herbicide resistance, given that that's going to have a significant bearing on the operating returns from that land? How sophisticated is our view in the market?
I think from the knowledge in the industry, from my perspective, is very, very good. It's just how well it's supplied is probably not that great.
I think we've got heaps of information available to make really good decisions, and I think it's used very variably.
Ross.
Yeah, Ross Kingold from AGIC. David, you touched on this, but to what extent is the profitability of the investment in the farm sector being limited by what's happening post-farm gate? Chris Clark, for example, in Landline, looked at the logistics costs of getting grain from farm to port in Australia. Is that an issue that you think is limiting the profitability of farm investment?
You're probably better to answer the question than I am. Look, I think yes, because we are relatively high cost at times. Investors, global investors, look at it from a global perspective and they say, well, what's the relative cost? And I think what we're doing is eroding some of our on-farm low-cost efficiencies in the sectors where we have a competitive advantage by the fact that we can be inefficient post-farm. So how much is that a constraint on the investment community? I don't think it's that big a constraint on the capital coming into agriculture. I don't think it's a major constraint, but that's a gut feel more than anything else. I don't have any numbers or any way of quantifying that.
Ross Charbonneau from Food Advantage, another Ross. Perhaps for both David and Graham, what is the information on the quality of the operators or the amount of talent in regional Australia in particular when it comes to this space, and how do you benchmark that with your data from perhaps other countries? Be interested in the views of the panel.
I know from that point of view we haven't tried doing any benchmarking against other countries, and it's only really been in the last few years that we've started to try and pull out this long-term top 25% in some of the data you saw today. And really just trying to identify partly who those people are and how well they're doing. And initially it was, I guess, looking for ideas about how we could do better with the technology and management and the skill that we have at the moment. And I guess as we're getting a bit further into it, we're starting to realise there's a whole lot of other games we can do there as well. There's really good talent there to generate some great returns. How that benchmark against other industries, I don't know. But I think it looks pretty good.
Graham, strategy logic.
Yeah, Graham Jennings, probably a question for Graham. Just interested in the debt funding that you see used on farms. So one thing's for sure, they've never a nice interest payment to make. But is there much diversity in how you're seeing the funds being used and leveraged?
Yeah, I guess if we break it up again into that top, middle and bottom type group, bottom group is really about survival. A lot of the time it's just trying to fund the next cash flow for the next year, and that's part of the reason why they're really struggling with their returns, because they're not necessarily making the best decisions for the farmers. But with profitability, but the top 25% are doing it pretty well in the sense that they're applying that capital, that debt funding for buying new properties, improving machinery, improving management. So I think it's a very different use. I guess I'm probably back to the finances again. I'm not sure how well that difference is actually recognised between the talent of the farmers or the capacity of the farmers and who's actually carrying the risk. If we look at our bottom 25% portfolio, part of the reason some of those guys can start at 0% return on capital for quite a number of years is they've actually got very high equities. They're sitting around 90% equity, and from a bank lending perspective, they actually apply very attractive lends. But some of the top 25% will be very comfortable at a 65 to 75% equity. the reason they go there was that they expanding or buying more property. So there's a real difference, and it probably shows the equity is not a good measure of capacity of the business.
Okay, question in front of you.
Damien Scanlon, a farmer and chairman of the Grains Research Foundation. My question revolves around capacity and where the panel might see the future of management capacity coming from in Australia. And is that an issue in the next 10 to 20 years? In fact, the capacity of younger people coming through, and where will they come from?
I'll take that one briefly again. Yeah, look, I think it's a real problem. The top 25% is some really good talent coming through it, and they'll be there, but it may not necessarily be available for anyone except for their own businesses. In the middle group, there's some good capacity there as well. But if we lose that bottom 25, then we're all of a sudden down to three-quarters of the size of the industry and very limited talent coming through. So, yeah, look, I think it's a problem that as an industry we're all address.
I think it's a really important issue, and there's been a lot of work done on it in the last 5 years or so. I think it's, from our business, it hasn't been a constraint. And I think actually a lot of the younger farmers are looking for career paths and professional development. And we'll often employ younger, relatively recent graduates in farm management roles, give them some support with more experienced people. And effectively what that means is that you're training them yourself. They come up with a base level of training, and then you've got to invest in them. And that's fine, that's good. And they might stay 5 years, they might go on, then they'll come back to you. But I think we need to be prepared to invest as well, not just say someone else needs to fix this. We've got to train them, we've got to give them the skills, we've got to give them the experience.
I might just take a question that comes out of some comments both Karen and Graham made. Graham, your comments around the gains being available from lifting the middle, if you like, up to the top, and that would imply a focus on training and extension and education. Although Karen made mention of the fact that making sure we get the research and development right, and of course the issue is that the productivity growth and the adapters, or adopters if you like, of that R&D are at the big end. So it's having the technology available for the big end and making sure the R&D is delivering that. So we've got that sort of conflict almost between an extension and education type effort at the middle to lift versus making sure we've got the technology out there in front of the big scale with the capital to make use of that. So how do you see that balance playing out?
Bearing in mind that middle group that we're talking about is about 4,000 hectare farm, and they're not really little known. Their turnovers are about $2 million, $1.5 to $1 million. So they're actually probably the group that Karen's talking about targeting. Look, I think that is yeah, it's just how we make those gains, those changes translate.
I don't really see there's any conflict there. I think there are those two issues. You have the technology leaders, but in order to improve overall farm performance, then one of the key things you can do is try to bring that middle group up into the performance category of the top. And you can do that through technology, you can do it through management performance, etc. But there are a whole range of issues in that as well.
Okay. I'm going to take two more questions here. 1, 2, and we're due for morning tea, and I'm sure there's plenty of opportunities for chats in between. So Mal.
Hey, thanks, Mick. I'm Wagner from University of Queensland. On this question of land values, I guess I wonder whether David or Graham have got any comment to make on the fact that many land purchases by successful farmers are making an incremental addition to their existing farm. And therefore, I think they're in a position to pay well above market value because there's a lot of added advantages in adding another parcel of land to your existing operation.
Agree completely. That's how it works. They're often a bit bigger, they're more profitable, they've got a stronger balance sheet, so they can more able to take it on. And when they take it on, they've got greater scope to increase the profitability of it. And we look at ag and we say that across the sector it generates a return, and that return's too low, therefore land prices are too high. But in fact, if you look at those farms that are expanding, their return on capital is up in the 6-8%. And so they can quite comfortably take on something next door, and they actually get 10, 12, 14% return on the marginal capital. And so it's a very attractive investment.
Last question, Ben.
Thanks, Mick. Ben Russell from Rowlink. Enjoyed all the talks. David, two questions to you. Do you have a view, I'm sure you will, on different categories of corporate investor? And I'm particularly interested in the category of longer-term investors like super funds, pension funds, versus more active fund managers like private equity and other funds where there's more regular transactions. First question, and second is a comment, if you will, on the performance of funds as corporate citizens, particularly in rural communities where my own personal observation in New South Wales, they've tended to be more takers than givers.
So the first one, private equity versus sort of more institutional money, I mean, superannuation money. Well, I think private equity in agriculture is like mixing oil and water. You know, I just don't think they fundamentally fit together. There might be the odd case where they do, but private equity seems to be about short-term, high return, high risk. And there's just misalignment there in terms of what you need for a successful agricultural investment. So the superannuation money that has a 10, 20, 30, 40-year horizon, I think is a logical place. But we've got to get our act together to attract it. So I think there's strong alignment there, and I think increasingly we're seeing those people allocate a portion of their portfolio, 1% or something. But it's a lot of money when you add it up. The corporates being takers rather than givers. I think there's a couple of comments about it. I think they often come in with a different model, but I don't think they all do the same thing. So I think I know some people tend to brand corporates as they sack all the staff, they pull all the fences out, they start the tractor up and they go from one end to the other and they use casuals and so it decimates the community. A more benign view of that is that that's a logical consequence of agriculture for the last 200 years as we've mechanised more and more and we've reduced the amount of labour required to operate agricultural businesses. And family farmers do that all the time. So if your family farm would be running with far fewer people than 2 generations ago. And so you're doing the same thing, it's just not quite as stark. And the reality is if we're going to have a successful agricultural sector, it's going to rely on fewer and fewer people and more capital, as in plant and machinery. So I think it's inevitable that small communities will be under stress as agriculture gradually restructures and needs to continue to do so to survive and be globally competitive. Some probably do it more drastically than others.